Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Donald Trump picks former venture capitalist and Ohio Senator JD Vance as his running mate. This as investors continue to ramp up bets on a Trump win in November. President Biden calls Vance a clone of Donald Trump. The US leader also defended his age and track record in an interview with NBC.
The idea that I'm the old guy, I am. I'm old. But I'm only 3 years older than Trump, number one. And number two, my mental acuity's been pretty damn good. I've gotten more done than any president has in a long, long time in 3.5 years.
And Jerome Powell tells us US inflation is heading in the right direction, reinforcing market bets that rate cuts are coming.
I would say we didn't gain any additional confidence in the first quarter, but the three readings in the second quarter, including the one from last week, do add somewhat to confidence.
Good morning, happy Tuesday. So US politics and Powell in focus for these markets. US stocks ended the day yesterday just below record gains. You saw gains coming through for financials, gains coming through for the energy sector as well. But the markets, of course, pairing and passing what we've been hearing, I should say, from Jay Powell, of course, of the Fed, speaking to us and talking about that greater confidence in getting towards that 2% target on inflation. Currently, FTSE 100 futures looking to losses of around 0.2%. European futures pointing lower by 0.3. It was a challenging day for European stocks yesterday, lower, ending lower by more than 1%, and it was luxury that was driving the losses yesterday. We have Richemont reporting in about 30 minutes' time. We'll break those numbers for you and see if that trend around luxury and the exposure to China continues. We, of course, continue to think about the prospects then of a rate cut in September. Markets now pricing in more than 2 cuts by the end of this time next year, by the end of this year. Goldman Sachs saying you could make the case for a cut in July. They say that's not their base case. They still expect the first one to come through in September. But certainly they say the conditions are there now for a cut. S&P futures then pointed to gains of 0.2%. Nasdaq futures pointing up by 54 points. We'll flip the board and look cross-asset. The focus, of course, on the US 2-year. The front end more reflective of changes in terms of sentiment around prospective cuts from the Fed. 444 currently with yields just down 2 basis points. Euro dollar at 108. A little bit more dollar strength coming through once again in the session today, up about 0.1% on the Bloomberg dollar index. $84 a barrel on Brent after 2 days of losses, stabilising just below $85 a barrel. And gold getting close to record levels, boosted, of course, by those rate cut expectations, 2,428, up 0.3%. Now, Donald Trump has been formally nominated as the Republican presidential candidate alongside his pick for running mate, Ohio Senator JD Vance. The Republican National Convention was Trump's first public appearance since that assassination attempt at the weekend. Meanwhile, President Biden has addressed concerns about his age and mental acuity in an interview with NBC.
The idea that I'm the old guy, I am. I'm old. But I'm only 3 years older than Trump, number one. And number two, my mental acuity's been pretty damn good. I've gotten more done than any president has in a long, long time in 3.5 years. So I'm willing to be judged on that. I understand why people say, God, he's 81 years old. Whoa, what's he going to be when he's 83 years old or 84 years old? It's a legitimate question to ask.
OK, US President Joe Biden, of course, speaking there. At this point, let's bring in Bloomberg's Bill Ferries. Bill, let's talk about that VP pick. We knew he was part of the group, but, of course, Trump keeping everyone on tenterhooks till the last minute in terms of his VP pick. What does J.D. Vance then bring to this Republican ticket?
Well, one thing he clearly brings is youth. He brings youth to a campaign where both of the major candidates have been criticized for their age. He also brings an aggressiveness, his ability to punch back, and that's something that American presidential candidates have historically looked for in their vice presidential candidate. Of course, Trump is different. He's not afraid to punch back at his opponents, but J.D. Vance will take on some of that responsibility as Trump's VP pick. It's not clear, however, whether Vance really brings in a lot of those independent and centrist voters who have remained undecided so far. Trump has the lead in a lot of the swing states. The real question we'll find out in the coming days is whether his pick of JD Vance helps him grow that lead or whether it stays the same at this point in the race.
OK, that's really interesting in terms of the independents and whether or not JD Vance can play to them, or if that is a challenge, as you suggest it could be. Bill, what have we been hearing from the President, Joe Biden? He continues to be active. This is clearly part of the playbook. They want to get him out in front of these interviews to try and reassure the Democrats and the broader public. What have we been hearing from Joe Biden, and what is his standing right now?
Well, the assassination attempt on President Trump, former President Trump, over the weekend really pushed a lot of the debate about whether Joe Biden should remain the candidate for the Democratic Party off the front pages. That said, it's still very much a debate that you're seeing taking place behind the scenes. I think the pick of JD Vance will only add to that more. But I do think in the coming days, particularly with the Republican convention well underway now, you're going to see a lot more of Joe Biden. They're going to try to get him out in front of the camera more often, try to have some more unscripted interviews, speeches where he's maybe not relying on the teleprompter so much. He's going to have to make a vigorous appearance, I think, over day after day to try to push back on this argument still taking place within a Democratic Party about whether he is the best candidate to lead them into November.
OK, Bill Ferry's wrapping up everything we've been seeing across the US, of course, with the VP pick and the latest interview from Joe Biden. Bill, thank you very much indeed. Let's cross over now to Singapore to check on the Asian markets. Avril Hong standing by. Bit of a soggy session so far, it seems, Avril.
I think soggy is the right word to use, as we see investors seemingly bracing for those increased chances of a Trump presidency, as well as digesting some of those comments from Powell. But that doesn't seem to be fueling much of the appetite for Asia equities, save perhaps in Japan, the Nikkei, managing slight gains, but paring them from early on in the session, maybe helped along by what's the cheapness in the Japanese yen, despite earlier after Powell's comments actually managing to hit the 157.2 level. The Hang Seng is the big drag today. Look at how it's 1.4% down. And this is an extension of the losses from yesterday after that big miss in China data. A bit of green on the CSI 300 might be the national team at work here. But I wanted to also highlight another bunch of stocks that we've been watching today, the EV ones, as investors seem to also be mulling what a possible Trump presidency, along with his pick for a running mate, might mean for EV subsidies. So we have LG Chem among the stocks that are really in negative territory today. Let's flip the board, and as we look through those developments in the US, let's also take a look at what we're seeing in the US and China tech stocks, because the correlation has just turned negative. If you take a look at the Nasdaq ETF versus the Crane Share China Tech ETF, you're basically seeing those two decoupling. So worth keeping in mind as we track all these developments. Let's flip the board again and take a look at what we're seeing in EM currencies, because up until this week, they have been managing gains for this month. Those expectations of Fed easing obviously at work here, but today it is another day of declines of offshore yuan, Korean won, Indonesian rupiah, among all the currencies that are on the back foot today in this part of the world, Tom.
Yeah, dollar strength being felt once again in that part of the world. Avril Hong, thank you very much indeed with the market check across Asia, joining us out of Singapore. Now, Fed Chair Jerome Powell says recent data is giving officials more confidence that inflation is moving towards that 2% goal. Speaking with Bloomberg host David Rubenstein, Powell highlighted the three latest inflation readings, but did not provide clear timing for a possible cut.
I would say we didn't gain any additional confidence in the first quarter, but the three readings in the second quarter, including the one from last week, do add somewhat to confidence. On inflation, in the first quarter, we didn't make any more progress. We've had now three better readings, and if you average them, that's a pretty good pace. The U.S. economy has performed really remarkably well over the last couple of years. Today, I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. We're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook, and also the balance of risks.
Let's bring in live strategist Mark Cranfield then for the analysis on what we've been hearing from Jay Powell. Mark, and I look down at my world interest rate probability screen on the Bloomberg, and we have close to 70 basis points, 67 basis points priced in by these markets in terms of cuts right now. Clearly, and not surprisingly, Jay Powell didn't give a time frame in terms of when the first cut comes through, but he's sounding a little bit more confident in terms of getting to that 2% trajectory. I guess the question is, are markets pricing in too many cuts at this point?
Well, there seems to be an irony, doesn't there? Because it was only just recently that the Federal Reserve changed their dot plot outlook to just one interest rate cut for this year. And previously they'd had three themselves. And now the market is almost where the Fed used to be. But you can see why they're so encouraged. And it's not just what they're hearing about inflation. What traders also heard from Jerome Powell was about cooling employment situation. And that probably is the thing that tips the Fed over the edge, because the employment market has been way too strong to justify an interest rate cut. Clearly, that's beginning to crack. He's noticed that. Other Fed members have as well. The inflation readings were going in the right direction, and we've heard quite a few people saying that they're happy with that path. Now you put the employment picture in together. You've got the two factors that the Fed needs. They're obviously getting pretty close. Powell doesn't want to admit to anything yet because he hasn't been able to form a consensus within the FOMC, but you can see that he's trying to lead them into the position where they can agree to do something. Now, whether Goldman Sachs is right that they go as early as July or not, traders will keep on pricing in that direction. And it wouldn't be surprising if we actually see a few bets being made for a surprise July move. Certainly, by the time we get towards September, if there's been no move in July, people might even think that the Fed kicks off with a big interest rate cut, maybe 50 basis points in September, because although Jerome Powell has said he's not influenced by politics and the election, no Fed person ever wants to do anything really close to an election date. So he may prefer to try and push the Fed into earlier, bigger rate cuts and then take a break as the election gets nearer. So there's a lot of things up in the air. The big picture for the bond market, it's all pretty favourable.
Really interesting. OK, so it's not, as you say, look, it's not priced in yet for July, but Goldman Sachs has put that in on the table, hasn't it, in terms of its assessment, in terms of the rationale. And then you suggest maybe a bumper cut coming through in September as the option. What would that mean for US assets then, Mark?
I think we're going to continue to see a very good mood right across asset classes. Equities, of course, they're thoroughly enjoying this. We've got rotation going on as well. Some of that is influenced by the fact that Donald Trump is the leader at the moment in terms of for the presidential vote. But plus there's earnings season going on. You've had some great rallies in things like the tech stocks. So that rotation will continue, but generally be favourable for US equities. The dollar probably can come off a little bit further. Even though we've seen a little bit of dollar strength, as you saw on Avel's chart earlier, that probably is not going to last too long. Because if you look at short-term US yields, they're coming down pretty fast. And that usually undermines the US dollar. So that has probably got further to play out. And then you think of what bonds mean for gold, what it means for commodities as well. Generally, this pretty risk-on scenario we have certainly going to go through to the July Fed meeting, but probably goes right through the summer, unless there's a surprise that comes out from somewhere that says that everyone's got this all wrong on inflation. Then this good mood is going to spread. Plus, don't forget, the European Central Bank is heading that same way. Bank of England may even surprise with a rate cut. And we've got Australia, New Zealand. Everybody wants to get in on the game. Everybody's inflation is going the right way. Global rate cuts are coming. The only one who isn't is Japan.
Yeah, Japan, once again, the outlier as these central banks, ex-Japan, chomp at the bit to push through with those cuts. Live strategist Mark Cranfield setting us up brilliantly with the analysis coming through and what we've been hearing from Jay Powell and the market adjustments to that. Mark, thank you. Here's what else to be thinking about today then. 10 a.m. UK time, Euro Area Economic Growth Survey is going to cross. That's at 10 a.m. UK time. We have seen some green shoots across this Eurozone economy, and we'll see if that survey builds on what is modest but seems to be a little bit more persistent turnaround in terms of the Eurozone economy. We'll see if that is confirmed with that survey. 1:30 p.m. UK time, we're going to get US retail sales. Really important, of course, in terms of gauge on the consumer in the US as we start to see a bit of softness in the labour market as well, with unemployment at 4.2%. So we'll see how that reflects across in terms of the retail sales numbers. Really important, of course. Later today we'll bring that to you, of course, when that crosses. And the Wall Street bank earnings story continues after a pretty decent set of results that came through from Goldman Sachs. We're going to set you up with that, by the way, and get a preview. But you have Bank of America reporting later today, amongst others. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak, by the way. Time terminal subscribers can go to DAYB Go. And, of course, you can see comprehensive coverage of the RNC in Milwaukee. Trump, of course, making his first appearance leading up to that set-piece speech from the former president, who has, of course, picked his VP. Coming up, is Xi Jinping's quest for tech-driven growth actually starting to pay off? We get the details in Bloomberg's deep dive on that subject. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the great rewiring of the Chinese economy is the focus of today's Bloomberg Big Take. Experts say Beijing's advances in EV, solar and chips are helping the nation navigate its property slump. For more, let's bring in Bloomberg's Min Lo in Hong Kong with the details. Min, what are these new productive forces that the Chinese government is trying to unleash, or has been unleashing, that is helping to rewire this economy and make it less dependent on that real estate sector that we know is facing such a squeeze right now?
Yeah, it's a buzzword of the season, and it's really that central guiding principle for economic activity at both the central and local government levels. And it's really Beijing just relying on its old playbook of using supply-side policies to boost the economy, but changing up the ingredients from your traditional manufacturing sector to your EVs, your chips, quantum computing, advanced medical equipment, and the like, rather than relying on those demand-side policies to boost consumption, because Beijing has always been quite reluctant to rely on the sort of welfarism that President Xi had said could encourage laziness. And so far, we have seen the PBOC getting on board by funneling more funds into EVs, into green energy and tech sectors, and the Ministry of Finance as well, pouring in plenty of funds into R&D. We expect that trend to continue in the next 5-10 years. And our Bloomberg economics team have projected that the new productive forces could make up as much as nearly a quarter of GDP growth by 2026, really making up for that shortfall that's left behind by the collapse in the property sector. And of course, this comes amid growing need for China to become more self-reliant as that threat of the US and its allies cutting off China's access to cutting-edge technologies increases as we go forward.
Yeah, really fascinating. To some extent, pushing back against that narrative, and Bloomberg Economics saying China might just be about to pull off a great rebalancing. Meanwhile, of course, the focus is on the plenum. That is a big political event underway in Beijing right now with significant policy implications. Where is the focus? What is the market sentiment around that event, Min?
Yeah, the market sentiment has been really weak. There's just very little optimism that the government will roll out the sort of big bang stimulus that markets are looking for. I mean, last week you saw that record high outflows from China ETFs in the US, capping 6 straight weeks of outflows. And you're also seeing that growing divergence between US and Chinese tech stocks really hitting a negative correlation for the first time in over 10 years. And it's a confluence of many sectors, because you have these string of very disappointing data coming out over the past few weeks, that trade data, a collapse in imports that turned negative for the first time in June, not for the first time, but turning negative and really missing expectations here. And then you have the activity data yesterday. The eye-popping number is really that retail sales number coming in at just 2%, and property as well, home prices continuing to decline despite the PBOC rolling out that rescue package in May. And then you have exports continuing to do the heavy lifting for the economy, but there's risk for exports as well, with a potential Trump presidency slapping 60% tariffs on Chinese goods. And we see UBS publishing a research note recently saying that those tariffs could potentially cut China's growth by half. And Goldman Sachs, by the way, had also reduced China's growth forecast from 5% to 4.9%. So plenty of uncertainty and geopolitical risks, and also risks of currency devaluation as well in the second half of this year.
Bloomberg's China correspondent, Min Lo, thank you very much indeed with a fantastic breakdown of the big take today in terms of some of that transition that is happening within rewiring of the Chinese economy, and of course the focus on that political gathering, the policy focus in Beijing this week. Coming up, South African officials heading to the US to lobby against a review into trade relations. We are live in Johannesburg for the details on that. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, South Africa's newly formed government is to use an upcoming forum on US trade access to push back against a Senate review into ties between the two countries. Let's get the details then from Bloomberg's Africa correspondent Jennifer Dabasaja, who joins me now from Johannesburg. Jen, what is the South African government, what are they hoping to achieve at this upcoming summit? I guess what are the potential consequences? What is at play here for this country?
Right. Tom, it's important to consider really the relations between these two countries. The U.S. is South Africa's second biggest trading partner behind China. And so this relationship is very important. And so earlier this year, when we did hear the U.S. House passed a bill to review bilateral relations, a number of business groups were concerned about how this could potentially impact trade and also impact the economic revival that this country so needs. And so now it is on the U.S. Senate to approve this. And so at this AGOA forum, which is happening next week, our understanding is that South African lawmakers are really going to speak with U.S. lawmakers about the importance of this for both countries, especially if you consider trade between the two countries amounted to surpass $23 billion in 2023. The importance of this and why this is really something that is not only good for the South African economy, but also good to stick to the promises made in the AGOA Act, which was made over 2 decades ago from the U.S. to support sub-Saharan Africa.
And one wonders how the US politics plays into this, given that focus right now on protectionism, particularly when it comes to JD Vance, the VP pick, of course, for Trump, that focus on isolationism and protectionism. How does that tie into this?
Right. And you know what was interesting? I was just taking a look actually at Project 2025, which is in some sense what potentially, if we do see this new administration from Trump coming in, their approach to foreign policy, and in particular what it would look like here in Africa. And they say it would be a shift away from some of what they call are some of the waste and misuse of aid funds and focusing more on strategic and security pursuits. And so really the time is of the essence, I think, for South African lawmakers, especially considering what we saw over the weekend in the U.S. and what could that potentially mean if we do see a new administration coming in with different policies.
OK, Jen Dabasaja in Johannesburg on that mission by South Africa to try to assuage or at least pressure the US and some of those lawmakers into adjusting and rethinking some of that trading relationship. Jen, thank you. Coming up, Donald Trump makes his first public appearance since the weekend shooting, unveiling his running mate for the November election. All the details on that crucial story. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Donald Trump picks former venture capitalist and Ohio Senator JD Vance as his running mate. This as investors continue to ramp up bets on a Trump win in November. President Biden calls Vance a clone of Donald Trump. The US leader also defended his age and track record in an interview with NBC.
The idea that I'm the old guy, I am. I'm old. But I'm only 3 years older than Trump, number one. And number two, my mental acuity's been pretty damn good. I've gotten more done than any president has in a long, long time, in 3.5 years.
And Jerome Powell tells us U.S. inflation is heading in the right direction, reinforcing market bets that rate cuts are coming.
I would say we didn't gain any additional confidence in the first quarter, but the three readings in the second quarter, including the one from last week, do add somewhat to confidence.
OK, from the macro to the micro, we have earnings crossing from Richemont, of course, the owner of brands including Cartier. In terms of the luxury space, which of course faced pressure yesterday with the earnings coming through, and from a number of companies, including Swatch, that took a big hit. Right now, Richemont coming through with first quarter sales just below the estimates, 5.27 billion euros. The estimates have been for 5.28 billion euros. So a modest, very modest miss in terms of the first quarter sales. We know the focus is going to be on the Asia part of the market and the exposure, of course, to China, and the comparables for Richemont were going to be a challenge. That was the assessment leading up to these earnings, given that the sales came through relatively strong in 2023. So the comparables are challenging. First quarter sales, though, essentially in line with the estimates, a very, very marginal miss. First quarter sales at constant FX increasing 1%. The estimates had been for an increase of 1.3%. In terms of the breakdown across regions, the Americas revenue coming in with an increase of 10%. So that was a beat in terms of what they've seen from the Americas. It was a beat coming through from Japan. And it was a positive picture as well in Europe. But it was Asia Pacific where they felt the squeeze. You're seeing revenue at a constant FX rate contracting out of the Asia-Pacific region by 18%. The estimates had been for a drop of 15% out of that region. So we'll continue to give you details on the Richemont story, and we'll get analysis, of course, and give you a wrap of what this all means for the luxury sector in the next few minutes. Richemont, as you can see, currently year-to-date, the stock up 18%. Let's check in on the broader markets right now as investors continue to adjust to the prospects, the increased prospects, it seems, that is a take from some at least, of a potential Trump victory in November. Of course, the pick of JD Vance as the vice president, but also with what we've been hearing from Jay Powell, saying he's getting a bit more confidence that they're getting closer to that 2% target, but also saying that the neutral rate in terms of interest rates could be higher than the period post-global financial crisis and pre-pandemic. Currently, FTSE 100 futures pointing low by 0.2%. European stocks looking to further losses after a challenging day yesterday. European stocks fell more than 1%, led by luxury yesterday, currently pointing low by 0.2%. S&P futures, though, it's a different picture. You've seen divergence between the European equity story and the US equity story in the last few days. European futures, US futures, I should say, pointed to gains of 0.2%. Nasdaq futures also pointing higher by 64 points. We'll briefly flip the board and look at the currency picture along with Brent, oil and gold, and the focus, of course, on the US 2-year, which is more sensitive, of course, to pricing around the Fed. 444 as markets price in about 67 basis points, more than 2 cuts for 2024. 444 at the front end on the US 2-year, with yields down a little over 1 basis point. 108 on the euro dollar. The dollar has strengthened, so it's putting a bit of pressure on the single currency. $84 a barrel on Brent, down 0.3%. And gold closing in to record levels, up 0.4%, 2,431. And that ties in to expectations of cuts from the Federal Reserve supporting the yellow metal. Now, Donald Trump has picked venture capitalist turned Ohio Senator JD Vance and as his vice presidential nominee after what the former president called lengthy deliberation and thought. Bloomberg's Tyler Kendall reports from Milwaukee.
We're here in Milwaukee at the Republican National Convention, where former President Trump officially announced his vice presidential pick, Senator JD Vance. He's a Republican from Ohio, and our Bloomberg audience might know him first as a venture capitalist and a member of the Senate Banking Committee. Now, if we look at the legislation that he shepherded through that committee, it gives us a sense of the type of politician Senator JD Vance has been. He's pushed through more populist bills focused on workers' rights against big banks, for example, such as a bill that would make it harder for big lenders to get bigger, and another designed to claw back executive compensation if banks fail. Vance is 39 years old, which marks a generational shift for the party, but he does align with former President Trump on many of the issues and is seen as appealing to white working-class voters. Also here in Milwaukee, delegates officially voted to make former President Trump the official Republican nominee. Up to this point, he's just been the presumptive nominee. It also secures the rest of this week's schedule. We now know that Senator JD Vance will take the stage on Wednesday night, and former President Trump will officially accept the nomination on Thursday. In Milwaukee, Tyler Kendall, Bloomberg News.
So, Donald Trump's choice of JD Vance as his running mate signals a break with the Republican Party's old guard on foreign policy issues. Speaking in Milwaukee, Vance said the U.S. is stretched too thin overseas and should focus on its own threats, such as China.
I think what President Trump has promised to do is go in there, negotiate with the Russians and Ukrainians, bring this thing to a rapid close so that America can focus on the real issue, which is China. That's the biggest threat for our country, and we're completely distracted from it.
OK, for more on this, let's bring in Bloomberg's Kriti Gupta. And Kriti, I noticed in the readout in terms of what was happening in Milwaukee that one of the former senators, Mitch McConnell, or current Senator Mitch McConnell, was actually booed when he went on stage, talking to that shift away from the legacy of foreign policy thinking within the Republican Party to this more protectionist stance and this focus on Asia away from Europe, it seems, that's articulated by the likes of JD Vance. If you're sitting in Ukraine, you're going to be pretty concerned at this point. If you're sitting in Beijing, arguably, you're going to be pretty concerned. What do we know about the foreign policy views of JD Vance and how they align with Trump?
This is kind of a carbon copy of how they align with President Trump. And I think that's one of the reasons President Trump chose to pick him in the first place. Remember, he's coming off of a vice presidency with Mike Pence here, who was very openly disagreed with President Trump on not only foreign policy issues, but how some of the electoral process kind of panned out with his loss against President Biden as well, refusing to push for kind of that 2.0. So when it comes to something like foreign policy, which we already know President Trump is going to be very aggressively tough on when it comes to China, for example, he needed someone second in command who's going to echo those voices, reiterate those thoughts, and really back it up with some of the money and some of the campaign financing as well with people who also think the same way. And that is really significant as well when we talk about the likes of Ackman, Musk, Ken Griffin, even potentially if he does sign on.
Yeah, there's a turn in Silicon Valley, isn't there, in terms of support for Trump? Not everyone, of course, but there are splits, it seems, within the Valley as to where to put your money. What have we been hearing from Joe Biden? Has he been making a more convincing case that age is not so much of an issue? Has the pressure on Biden retreated around that? What is your take on what we've been hearing from the president?
Well, post-assassination attempt, tragically, of course, a pretty dark moment in American history. A lot of kind of Biden nominees, a lot of that tough rhetoric has been pulled back simply because some of the other contenders don't really want to go up against that. You've seen the polling odds really shift in President Trump's favor for a variety of reasons, even among independents as well. So that's going to be one aspect to it. The other aspect to it is, look, he's still making a pretty concerted effort in terms of appealing to the policy side of this, really saying that, look, at the end of the day, you are still trying to focus on President Trump being bad for the country or focused on not helping enough with his NATO allies or simply lying in the debate. There's some of the arguments that President Biden is making, but to kind of counteract some of that and take some of the pressure off a very sensitive moment, especially when it comes to things like gun control domestically in the states right now, President Biden has also been pushing forward things like potential rent control or rental caps on housing. So the Washington Post reporting this, a 5% rental cap is something he's talked about before, is something he would potentially see through in a second term. And it would just mean that across U.S. housing, so about 50% of housing units, it would have a 5% annual rental cap. What that does for the economics and for the financial audience is that there is a historical precedent of this. President Nixon did it back in the 70s and actually, although helped for about a 72-day period, ended up creating a very stagflationary era afterwards. So that might be something that comes up on Powell's agenda if Biden does end up getting this.
Really interesting, the history of that, given that, of course, Nixon was a Republican pushing through a rental cap. Kriti Gupta, thank you very much indeed. Anchor, of course, at Opening Trade, but with the finger firmly on the pulse of US politics. We appreciate the analysis and the update. Now, Elon Musk, talking of US politics, and an update here. Elon Musk pledging to pour $45 million per month into a pro-Donald Trump political group. The planned cash infusion could help build Trump's fundraising advantage over President Joe Biden, who has suffered, of course, from a donor revolt in recent weeks, with some calling for him to step aside after his debate performance. The billionaire entrepreneur endorsed Trump after that assassination attempt on the former president's life. Fed Chair Jerome Powell says recent economic data is giving officials more confidence that inflation is moving towards their 2% goal. He spoke to Bloomberg's host, David Rubenstein.
The labor market remained very strong, unemployment remained very low, and inflation came down at quite a sharp pace, particularly in the second half of the year, by a very large amount. And that forecast was almost unheard of. It was unheard of before 2023. So big upside surprise that year. This year, we had expected the economy to slow a bit gradually, the labor market to continue to gradually cool off after being overheated a couple of years ago, and inflation to continue to make progress. And something like that is basically what has happened. The economy is growing now at about 1.5% in the first half of the year. Most forecasters have about a 2% growth rate for the full year. The labor market, again, has moved into better and better balance to the point where I think you can now say it's essentially no tighter than it was in 2019 before the pandemic. Remember that the labor market of 2019 was a very strong labor market. So we're back to that place, no longer overheated. On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. We've also said that we're a dual mandate bank. For a long time since inflation arrived, it's been appropriate to focus mainly on inflation, but now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're in much better balance, and that means that if we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
Okay, I think I understand. So to put it in terms I can for sure understand, the markets are suggesting, the futures markets, that there's a 90% chance that the Fed will lower its discount rate in September. Do you think the markets know what they're talking about?
So today I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. I simply, we're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook.
OK, Fed Chair Jerome Powell not being drawn right there in terms of the timing, the exact timing for the first cut. Speaking, of course, with Bloomberg's David Rubenstein at the Economic Club of Washington. Now, of course, the macro policy ties in to the financials and the banking space. And Goldman Sachs is the latest of the US banks to report their earnings, with its trading unit and capital markets business helping to drive better than expected results in the second quarter. CEO David Solomon told analysts the US economy remains relatively constructive.
On the one hand, there's a high level of geopolitical instability. Elections across the globe could have significant implications for forward policy, and inflation is proven to be stickier than many had anticipated. On the other hand, the environment in the U.S. remains relatively constructive. Markets continue to forecast a soft landing as the expected economic growth trajectory improves and equity markets remain near all-time highs.
OK, for more, I'm joined by Bloomberg's Charlie Wells, who's been following all the banking earnings stories for us, giving it the context. Charlie, thanks for joining us. Talk to us what you saw from Goldman Sachs, what stood out to you, and what you're looking for Bank of America and Morgan Stanley later today.
Yeah, well, what stood out really was that term relatively constructive. I feel like you kind of have to say that after Goldman's earnings, which across the board generally were very positive, from trading to debt and equities underwriting. The surprise there, though, was a miss on M&A advisory. Goldman tends to lead the pack here, but they're about $100 million behind J.P. Morgan. That's going to be a surprise. As far as Bank of America and Morgan Stanley, Bank of America has been floating the fact that net interest income may be in a trough in the second quarter, but investors have actually liked the idea that that could propel forward in the future. Morgan Stanley, look, their shares have been underperforming peers, but what we're really looking for is, boosts from these elevated markets in that trading unit and potentially some healthy wealth management as well.
Charlie Wells, thank you very much indeed. Looking ahead to Bank of America and, of course, Morgan Stanley with the breakdown of Goldman Sachs that crossed yesterday. Charlie, thank you. Coming up, the luxury sector will be in focus, and the luxury sector has something of a China problem. We're going to break down the numbers just out from Richemont, give you the context on that one. Stay with us. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Richemont first quarter sales came in a touch weaker than expected as the Swiss luxury company saw continued weakness in Asia. For more analysis, let's bring in Andrea Felsted from our Bloomberg Opinion team, who follows this space very closely indeed. Andrea, let's start then with Richemont, because it was a challenging day yesterday for the luxury space in Europe in terms of the losses that we saw coming through from the likes of Swatch. But we'll start with Richemont. It seems like, in terms of the numbers that came through, the top lines, the exposure to Europe is OK, the exposure to the US is OK, but it is Asia and China that seems to be a key challenge for Richemont.
That really is. So the thing is, for the last 3 months, we've been up against this time last year when we were really in that very hopeful period that China had reopened, there was revenge spending, and it was going to continue. It didn't continue. It did weaken in the third quarter onwards, but we're up against that time when you know, things were reopening, it was really going very well. That's reflected in the numbers this year.
OK, so the comparables are really challenging
exactly.
as well. What is your take? I mean, it was such a big hit to some of the big names yesterday. I mean, Burberry was the biggest loser, down, I think, about 16%. Swatch took a double-digit hit as well. What is going with the luxury? Is it all China, or is there something else going on?
There's two things going on. The market is very polarised. So if you've got a really in-demand brand, and Richemont has two very in-demand brands, Cartier and Van Cleef & Arpels, you're more insulated. So if you're a weaker brand, such as Burberry, hasn't really got the cool factor despite the efforts, some of the Swatch brands, not so in demand, you're struggling. There's also a question of who you're selling to. We've still got this other polarisation going on, whereas the wealthy are still spending on jewellery, on Brunello Cucinelli cashmere, on Hermes handbags, but it's that more, they're called the aspirational luxury customer. What it means is someone they're comfortable, but they're not super wealthy, and they're affected by inflation, higher borrowing costs, and they're the ones that are pulling back.
Now, that's really interesting in terms of the divergence within the consumer base. So if you're really high-end, really premium, you're still holding on to your customers. Aspirational is feeling a bit of a squeeze. Do you have any sense as to when the picture in China turns around? What are we hearing from executives? I mean, how much confidence is there that the China story will turn around for them?
There's not a lot of confidence at the moment. That is the big worry that everybody has, how long China continues to struggle. And it's not just at home in China. What everybody is waiting for is the Chinese travellers coming back. That's happening a little bit, but it's not happening to the extent that might be expected. And when they travel abroad, typically they spend more. So that's really what we're looking for. There were some hopes it might happen towards the end of this year. Now I think recovery across the sector is looking much more like a 2025 factor.
Maybe a 2025 factor. And you a bit of a burn there on Burberry. It doesn't have the cool factor. Andrea Felsted, you heard it officially. I mean, that certainly seems to be part of the narrative yesterday. What happens with Burberry?
Well, I think there's a good chance it moves down market, which I think is a big mistake. They've worked very hard for the last 10 years to really try and elevate it, and I think the product was good. There's been a lot of criticism of Jonathan Ackroyd, former CEO of Daniel Lee. The product was a step up, but it just never seemed to get that buzz. And what it really needed was just to inject that buzz, because the question about the pricing, I think that, yes, they did raise prices. Perhaps they raised price a bit too quickly. But to me, that was a red herring. It just needed the buzz. It needed the cool factor. I can't see how it gets that if it turns into Michael Kors.
Is Harry Styles still an ambassador for them?
No, he was Gucci.
Oh, he was Gucci?
Yeah,
I got that one wrong. I thought that's why I don't cover luxury.
That's one of the reasons why Gucci was so cool, because right in the very early days, you had Harry Styles wearing the floral suits. You had Beyonce in head-to-toe Gucci. Burberry just never seemed to get that.
Andrea Felsted, always excellent on the luxury space. Thank you very much indeed. Opinion columnist, of course, from Bloomberg Opinion on this luxury space. Andrea, thank you. There's plenty more coming up. Stay with us. This is Bloomberg.
On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace.
Our interview with Fed Chair Jerome Powell saying he does see more confidence that the Fed is making that progress towards that 2% target, not committing to a time frame. But this is what markets are expecting, and this is the adjustment, the pricing that's coming through for the markets. The white line is representing September, the blue line November, and then, of course, the yellow line is December. So September fully priced for a 25 basis point cut. November also pricing a full second cut in November, and markets starting to think that maybe you get 3 cuts by the end of this year with 64 basis points. In fact, the last time I checked, it was closer to 67 basis points priced in by these markets by the end of 2024. Goldman Sachs saying the rationale is there for a cut, and they say the rationale is there for a cut in July. It's not their base case, but they said you could make the case certainly for a July cut. That is not being priced in by the markets, at least not yet. Let's flip the board and have a look at what this is all doing for gold, because the yellow metal is getting very close to record highs, and part of that story is the geopolitics, certainly a hedging effect, but also, arguably more importantly, expectations of those rate cuts. So continue to watch the yellow metal as it edges closer to those record highs. And flip the board again, because it's retail sales data coming out later today in the US. Really important gauge, of course, in terms of the health of the consumer. Higher interest rates, the squeeze there, hourly wages coming in a little softer. To what extent is that going to drag on retail sales? Expectation is that for the month on month, you're going to get a contraction of 0.3%. So that's going to be really important in terms of building out the picture in terms of what is arguably a slightly more constrained US consumer right now. So focus on that. We'll be breaking that data for you later today, of course, giving you the analysis. The opening trade is up next. We're going to be continuing to talk about the market reaction, of course, to what we've been hearing from Fed Chair Jerome Powell, to the politics of the US, to JD Vance being picked as VP by Trump, the more protectionist tilt coming through from that Republican nominee and his VP, of course. The opening trade is up next. Stay with us. This is Bloomberg.